Good day all. This is Accounting with Felix Sunday. Today's episode we shall be discussing a topic titled Accounting Equation. Accounting equation is very fundamental to the understanding of the double entry principle. It also helps in preparing simple statement of profit or loss and also a simple statement of financial position. It also helps us to understand the principle of entity concept in a business. By definition, accounting equation can be defined as a relationship, or rather as a statement that shows the relationship between elements of financial statements. Thus, accounting equation can be defined as a statement that shows the relationship between elements of financial statements. That is what accounting equation mean. It is expressed as assets equals to equity plus liability. This is asset-based accounting equation. You can make this equity the subject of the formula. In that case, you have your new accounting equation to become equity is equals to assets minus liability. You can as well make the liability subject of the formula. Say liability is equals to assets minus equity. These are elements of financial statements. We have 5 of such elements, which include 1. Assets, 2. Liability, 3. Equity, 4. Income, 5. Expenses. This represents elements of financial statements. When you relate any of these statements, it gives you an accounting equation. Now, what I did here, these 3 are asset-based accounting equation, relating these 3 elements together. We can as well relate these 2 to give us accounting equation, and that is called revenue-based accounting equation. It goes thus. You therefore say income minus expenses, it will be equals to profits. Sometimes it could give you loss. That will be when the expenses is greater than the income, the result will be a loss. But when the income is greater than the expenses, the result will give you a profit. This is also an accounting equation. You can as well make expenses the subject of the formula. In so doing, or let's make income now the subject of the formula. It will become income is equals to expenses plus profit. Let's make expenses the subject of the formula. It becomes expenses is equals to income minus profit. Let's make profit subject to the formula. You have it to be profit is equals to income minus expenses. Any of this gives you accounting equation. Like I said from the beginning, that accounting equation is a statement that shows the mathematical relationship between elements of financial statements. And we have 5 of such elements, which include assets, liability, equity, income, and expenses. When they are expressed to relate with each other, it gives you accounting equation. You can only relate assets, equity, and liability separate, and relate income and expenses separate to give you profit or loss. We shall go further to explain each of these elements of financial statement one after the other for better understanding. Let's start with explanation of what an asset means. Asset is one of the elements of financial statements. These assets represent items owned by the business, controlled by the business. It also represents property, stuff, or resources the business combine to generate revenue in its daily activity. These are assets. However, by definition, asset can be defined as present resource controlled by an entity as a result of past events from which economic benefits flows to the entity as a result of the usage of such assets. It goes this way. Assets can be defined as present resource controlled by an entity from past event from which economic benefit is expected to flow to the entity as a result of its being used. That is what asset represents, a present resource controlled by entity as a result of past events from which economic benefit is expected to flow to the entity as a result of the usage of such assets. Assets are used to generate revenue when they are combined. We have different types of assets, ranges from land, building, furniture and fitting, plant and machinery, equipment, motor vehicle, the cash, bank, trade receivable, prepayments, intangible assets like goodwill, franchise, patent right, brand name, licenses, software. All these constitute assets. However, assets are classified into two this way. Classification of assets into two. We have the first one called the non current assets. And the next classification is the current assets. Remember, the topic is accounting equation, which we say is a statement that shows the relationship between elements of financial statements. And we say we have 5 elements of financial statements, which include assets, liability, equity, income, and expenses. So we have picked one of such elements, which is assets, trying to explain in detail what asset of a business entail. Like we're explaining here that we have two classes of assets, the non-current assets and the current assets. The current assets, by definition, are assets that are held for trading. That's number one. One, assets held for trading. This includes your finished goods. It also means assets that are expected to be recovered in the ordinary course of business. Assets expected to be recovered in the ordinary course of business. Lastly, there are assets that are expected to be recovered within 12 months after the end of the reporting date. Assets expected to be recovered within 12 months after the reporting period. Any asset that falls within the class is regarded as current assets. The first one, assets that are held for trading, like your finished goods. They are held for trading. The cash are held for trading. Then when you come to the next one, asset expected to be recovered, not only recovered, sold or consumed. Consumed. Assets that are expected to be recovered, sold, or consumed in the ordinary course of business, such as your raw material, such as your finished goods, such as your trade receivable, expected to be recovered within the 12 accounting period of the business. And the third one is asset expected to be recovered within 12 months after the reporting period. Everything that falls within this class are regarded as current assets. By common knowledge, we will say that current assets are assets whose lifespan extends just within 1 year. By common knowledge. Example of such include number one, A will be your cash. B will be your bank. C will be your trade payable, trade receivable. Trade receivable. D, prepayment. E, short term investment. F, bill of exchange receivable. Okay, and so on and so forth. Any of these are regarded as current assets. They are assets of the business. They are present resources. They are acquired from past events and they generate economic benefit to the entity. These are current assets. Let's now come to non-current assets. By common knowledge, current assets are such assets whose lifespan extends beyond one accounting period. By standard, any asset that does not fall within this class are regarded as non-current assets. Non-current assets is further divided into two. Non-current assets further divided into two. We have the tangible and the intangible. Tangible, intangible. The tangible assets are those assets we could see with our eyes, we could feel we could touch. These are tangible assets. Examples include the motor vehicle, the land, the building, the furniture, the fittings, the machinery, the plants. These we could feel, we could see, we could touch. And these are depreciable. They can be depreciated. While the intangible assets are assets that are not visible to the eyes, but they are present in the business. They are defined as fictitious assets or assets without physical substance but have economic value, economic benefits. Examples of such include goodwill, patents, copyright, brand name, franchise, licenses, software. The standard that treats this is called IAS 38. Non-current intangible assets is treated by IAS 38, while the tangible assets also have two standards that treats it. We have one is treated by IAS 16, the other is treated by IAS 40. The IAS 16 is called PPE, meaning property, plant, and equipment. Example of such or component of PPE include your land and building, motor vehicle, plant and machinery, furniture and fittings. So this include land and building. This is plant and equipment, motor vehicle, and furniture and fittings. They are dealt with by IAS 16, while IAS 40 talks about investment property. Investment property. And these are immovable items of PPE. If you look at this PPE now, we have land and building, plant and machinery, motor vehicle, function and fitting. Which one do you think are immovable? That one is what we call investment property. And that is land and building. That's the only one that is treated as investment property when they are held for capital appreciation, when they are held to yield rental income, they are regarded as investment property. So this is asset in general. The non-current and the current, these are what qualifies any asset to be a current asset. These are the example. These are non-current assets. These are subject to depreciation, while these are subject to amortization. By this, we've explained one of the elements of financial statements. And by accounting equation, Going by our accounting equation, assets is always equals to equity plus liability. This is the accounting equation for an asset. Making asset the subject of the formula, it gives you asset equals to equity plus liability. Having dealt with assets, let's now go to liability. Now, liability, the second element of financial statements. What is liability? Liability represents what the business owes third party, what the business owes the external parties. They are defined as present obligation of the entity arising from past events for which settlement will result in the outflow of economic benefits. I take it again. Liability is defined as present obligation of an entity arising from past events for which settlement will result in the outflow of economic benefits. This is it. Present obligation of an entity arising from past events for which settlement will result in the outflow of economic benefits. This is liability. What the business owe to third party. Example of liability includes loan, could be long-term loan, short-term loan, accruals, trade payable, what the business, goods and services the business collected or enjoyed but have not yet paid for, bank overdraft. All this constitutes liability to the business, to the entity. Liability are divided into two or classified into two, which include current liability and non-current liability. It goes thus. Classification. We'll start with the non-current liability and the current liability. Let's start with the current liability. This liability represents number one, all items that are expected to be settled, all obligations rather, that are expected to be settled within the accounting period. One, obligation expected to be settled within the accounting period. That's one. Number two, there are obligations that are held for trading purpose. Obligations held for trading purpose. And number three, current liability are liabilities that are expected or obligations that are expected to be settled within 12 months after the accounting period. Obligation expected to be settled within 12 months after the accounting period. By standard, any item that falls within this definition are classified as current liability. Any other items that do not fall within this definition are regarded as non-current liability. Non-current liability includes such liability whose settlement will take more than one accounting period, 2 years and above, to get settled. Example, loan, or you call it loan note, or you call it long-term loan, long-term loan. Number two, you have debenture, and next you have deferred tax, deferred tax liability, and you have preference share. We also have contingent liability. Why the example of the current liability include number one, the A, you have your trade payable. You also have B, your accruals. C, you have your bank overdraft. D, you have your current tax liability. E, we have your other short term liability. All this constitutes your liability. Remember, we are looking at accounting equation, and we say it is a relationship between elements of financial statements. And when I said we have five of such elements, I've given you the assets. This is the liability. If we want to make liability now a subject of the formula, it becomes accounting equation becomes liability will be equals to assets minus equity. This is the accounting equation, making liability subject of the formula. This is your liability. The definition again, we say liability are present obligation of an entity arising from past events for which settlement will result in the outflow of economic benefits, classified into two, the non-current and the current liability. Now, I'm giving you definition of the current liability. Whatever doesn't fall within this class are regarded as current liability. We now move to the next element of financial statement, which is equity. Equity. Equity is one of the elements of financial statements, and it can be defined as the residual interest in an entity that are attributable to the owners of the business. The residual interest in an entity attributable to the owners of the business. What is equity? Equity are what is left over in the business that could be given to the owners of the business. Equity is derived after you have paid the third parties, the financial institution, the suppliers of goods, their money, their obligation. Whatever remains from the asset of the business becomes equity, becomes, is attributable to the owners of the business. It is expressed as equity equals to asset minus liability. We have components of equity, which ranges from number one, ordinary share capital. Share capital. Number two, odd share premium. Share premium. Number three, retained earning. Retained earning. Number four, revaluation reserve. Number five, general reserve. General reserve. Number six, other components of equity. Of equity. These are components of equity. Equity is equals to assets minus liability. This gives us the three elements on asset-based accounting equation. Remember, I said we have five of such elements of financial statements. We have dealt with three: assets, liability, equity. Let's now go to income. Income. This is the number four element of financial statement. Income is said to be the gross inflow of economic benefits in an entity. The gross inflow of economic benefits. It can be defined as the increase in assets or decrease in liability that result in increase in equity other than those contributed by holders of equity share capital. Definition: income can be defined as increase in assets or decrease in liability that results in increase in equity other than those contributed by holders of equity share. This is income by standard definition, or you can say income is the gross inflow of economic benefits. Examples of income include revenue, number one,